Condor video coaching series. We've talked about the scan settings that I use. We've talked about how to get those scan settings pulled up into the gadgets area, how to link the gadgets area with your trade tab, your analyze tab, risk profile and probability analysis, and your charts tab. We've talked about the core framework. Liquidity is king. Prefer diversified underlying, but if that's not mandatory. We want the underlying to be 30 days or more away from earnings. We want our IV percentile to be as high as possible, since this is a premium selling strategy. We want to sell the premium when the volatility is at or near 52-week highs, not when it's at lows, because then it has a higher probability of decreasing, which benefits you, the premium seller. We also talked about our duration window, which in the case of an Iron Condor, since it has a long and short option 1-to-1 ratio, the duration really, you don't get as much theta decay as you do with, say, a naked put or a short strangle, like we've talked about in the previous 2 video coaching series. So don't necessarily need quite as much duration. More duration is not going to necessarily hurt you, but 25 to 50 days is plenty of duration. So I like to stay in that 25 to 50 day duration window. If I'm going to go outside that window, I never go below 25 days. I will go above 50 days. My sweet spot is 30 to 45 days. So, based on that stuff, we are going to use December. Oh, market just closed. We're going to use December with 29 days left. And we looked at a few, we rolled through and talked about, in part 2, we talked about how to quickly determine liquidity using the linked up gadgets and trade tab. So we found GDX as a highly liquid underlying, and it also helps that GDX has 96.78 IV percentile. So we've got a really nice high. And it also helps that GDX has a nice high IV percentile. So we've got fairly high vol index, 51.29%, and we've got a nice IV percentile at roughly 97 here in GDX. So you can translate that if we go over here to the charts. You can see, if you're looking at the bottom portion of the screen, if you're looking at this implied volatility chart, you have a 51.13 is the current, and that's pretty much 52-week highs. So we're pretty much at 52-week highs. You can see the IV percentile at the top left, 96. If you want to get this implied volatility chart on your screen, all you do is go to, what is it, studies, I think? And you go to edit studies, or add studies, sorry. And then you go down here to volatility studies, and you add the imp volatility, which is short for implied volatility. And that's going to put this down at the bottom of your screen here. So another thing I like, so we're looking at a 52-week chart. The IV percentile gauges, where is the current implied volatility on this chart as compared to the past 52 weeks. So we're at the top end of the range. We're at the very top. If we were down here in the 23 range, then we'd be at the bottom of the 52-week range, so our IV percentile would be 0. If we were right here in the middle of the range, then our IV percentile would be 50. And so now we're at the top of the range. We're pretty much damn near at 100. Another thing I like to do is roll out to a 5-year chart. Now, this isn't mandatory by any means, but it's just a little helpful. So if you look at a 5-year chart, you can see that the 5-year lows were right around that 23 range that we were at earlier in the year. And the 5-year high is all the way back here, and it's around 56. So we're pretty close to 5-year highs. You can see previously we'd been right around this 50 level, and it had seen some resistance there and slowly trickled down. But whenever I'm at or near 5-year highs, not just 52-week highs, but 5-year highs in the implied volatility, I'm even more aggressively selling premium. So GDX is in a pretty prime premium selling scenario right now, given this implied volatility placement on the 5-year chart. Let's see, let's just make sure there's nothing over here. Yeah, there's a little pop here, and that is still 55. So 56 right here is pretty much the high, right around 56, and we're currently 51. So yeah, that's pretty. That's a good situation. I would say it's highly probable that a volatility crush is coming very soon in GDX. and being short premium, that means you will benefit from that volatility crush. Now, where it goes directionally is a different story, and that's where the Iron Condor comes in play. So let's take a look at GDX and see what we can do from an Iron Condor perspective. So we know that we are going to be using December. We could use January if we wanted to. Maybe we'll take a look at both. So the next question, now that we've determined that it's liquid, we've determined that this in fact is a pre-diversified or a diversified underlying, being that's an ETF that reflects gold miners, and we don't have to worry about earnings being out 30 days or more because it's an ETF. We've determined we're going to use December because it falls within our range. We've determined that this is definitely meets the criteria of IB percentile over 50 because it's damn near 100. So now how do we determine which Iron Condor to build? Well, what I generally like to do is I'll start at the leg that's right around 30% probability in the money. Let me change this up a little bit. It's a little crowded up here. I'm going to get a few things out of there. So I'm going to change it to the standard volume open interest. I'm going to customize that. And I'm going to add probability in the money. We'll just use these three metrics here. So now what we have is bid, ask, volume, open interest, probability in the money. So I like to start with the strike that's right around 30% probability in the money. Let me change this to all. So our 30% probability in the money, the closest one is going to be 18. So what I'll do is I'll sell this 18. Let's take a look at that. And let's say we want to do a 2-point wide. I'm holding control right now on my keyboard. And let's say we want to do the 16, which is 2 points wide, so it's 2 points away from 18. So we want to buy that, so we'll hold the control key and left click the ask on 16. Then we'll figure out which one strike do we want to sell on the call side. Well, which one's closest to 30% prob ITM? That would be the 21. So I'm still holding control on my keyboard, and I left click the bid on the 21 call. And we want to stay 2 points wide. Let's keep this balanced. So we're going to go down to up to the 23, and we want to make sure we're clicking the ask. All right. So the next thing we want to make sure is our minute. So that's how you select the strike. That's how I start. So I'll look at the strike. I'll sell the strike that's closest to around 30%, 30-35% range, and then I'll usually go 2 or more wide. I don't usually do 1 point wide Iron Condors. I usually do 3+. But this is a very low price underlying at 1971, so I'm not sure we're going to have a great opportunity going 3 wide. So that brings me to another point. First thing we want to do is make sure our minimum credit is, so this is another piece of criteria, minimum acceptable credit is 30% the width of the spread. So in this case, you either look at the call spread or the put spread, or a combination of the two if you have unbalanced widths. So in this case, we know we have 2 on the put side, 2 on the call side, so it's 2 points wide, our Iron Condor. So what is 30% of 2? Well, 10% of 2 is 20 cents. So multiply that by 3, you get 60 cents. So 60 cents would be 30% of the width of the spread in this case, which is 2. So we want that credit to be at least 60 cents. You can see here we've got 67 is our mid price. Will it fill at 67 cents? I don't know. Maybe. The NAT is 58 cents, so we've got a 9 cent wide mid-NAT spread, which tells you that there's a lower likelihood that you'll fill right at the mid. You may have to go down here to say 65, which puts us 2 cents of slippage on the spread, but it still is 5 cents above our minimum acceptable credit of 60 cents. So we've got a good scenario here. One thing I always do is I double check the strikes that I've chose here. So I look at the 18 and 16 strikes on the put side. Alright, this 18 strike, 41 cents, 45 cents. We've got a 4 cent wide bid-ask spread. That's pretty solid. We've got volume of 182. That's okay, but it could be better. Open interest is solid. If we go to the 16 strike, it's a very low number here, 11 cents. Bid-ask spread's really tight. I'd like to see a higher number than 11 cents, but with this little amount of duration left and this far away from the money, I guess you can't really expect much more than that. But takeaway is tight bid-ask spread, 3 cents. Volume is meh, and the open interest is solid. What about here on the call side? We did the 21 call. We sold that one. So we've got 5 cents wide bid-ask spread, plenty of volume, plenty of open interest. On the one that we purchased, we've got a 6 cent wide bid-ask spread. That's still not bad. Volume is very questionable, and the open interest is very solid. So, you know, this kind of explains our mid-nat spread. We've got a variety of different bid-ask spreads. Some are super tight, some are a little bit wider, but they're all pretty decent. We've got a variety of different volume scenarios here. Some of the strikes have good volume, some of the strikes have less than good volume, and everything has pretty good open interest. So, you know, all in all, that kind of defines a moderate liquidity picture on the overall spread, and that is reflected down here in the mid-nat spread, which is 9 cents wide. Of course, you want the mid-nat spread to be as tight as possible too. You know, 1 cent mid-nat spread is perfect. A 9 cent mid-nat spread, not so perfect, but you gotta do what you gotta do when you're working with a 4-legged spread. You know, so what I'll usually do is I'll start working it at the mid. I'll give it a couple minutes. Then maybe I'll go down 1 cent. Cancel, replace the order, go down 1 cent. Give it a couple minutes. If it doesn't fill there, I'll go down to 65. I'm thinking this would probably fill at 65. Can't be certain. What I could probably be certain of is it would fill at 64, because you can see here at 64, it's got 22 cents to spare. Whereas at 65, 7 cents upside is required, theoretically, for it to fill. But I think that's close enough to where you would probably fill pretty quickly. So that's very important. You know, a few things that we've discussed here: how to choose your strikes. You know, we'd already determined the duration window, so how to choose your strikes to sell is most important. So we chose these strikes that are closest to 30%, and we went 2 points wide since this is a lower price underlying. I prefer to go 3 to 5 wide, sometimes even 10, 15, 20 wide, but those are on really expensive underlyings. And, you know, I just kind of reiterated that you want your credit to be at least 30% the width of your spread. I try to get as close to that 30% as possible, because that allows me to get as wide as possible on that Iron Condor, as far away from the money as possible. Because the lower your credit, the wider your Iron Condor is going to be. But if you go much lower than 30% the width of the spread, then you really don't have a great profit opportunity if you take profits at, say, 50, 25% value decay, which we're going to discuss when part 6 or 7. So, you know, we discussed that, and then we discussed kind of double checking your individual legs to make sure that there isn't one specific leg that is just really screwing up the whole liquidity of the spread. In this case, there really wasn't. I mean, this 16 is probably the worst with the 96 volume, but I think the other one had pretty bad volume. Yeah, 62. So both of these outer legs, the legs that we're buying, volume's pretty low. The bid-ask spread's tight enough to where I think there's a market there. In some cases, you may see one of your legs have 0 volume, and if you're having trouble filling on your Iron Condor, that would explain that. But in this case, I think this Iron Condor would fill, and I think it would fill at 65. So we'll stop there. We'll move on to part 4, where we're going to discuss minimum probability of success. We're going to take this over to the Analyze tab, discuss minimum probability of success, and a few other things. So I'll see you there, part 4.